Good morning, everyone, and welcome to another module of our second season of our GWBC Accelerate Series. My name is Sherelle McNair, and I am one of the programs and events coordinators for the Greater Women's Business Council. And I want to thank you for taking the time early this morning to join us for another module where you are going to get some robust information and additional nuggets, best practices for growing your business. In the meantime, while you're here, be sure to follow us on social media and using the hashtag GWBC Accelerate to post about your experience this morning. We are on Facebook, LinkedIn, and Instagram with the handle GWBC Live. And be sure to talk to us. This morning's module is going to be very engaging. Our panel is so amazing, and they really want to hear from you all. So be sure to place your name, your company name, and your location. We want to know where you're from this morning. Are you from Georgia, North Carolina, South Carolina, or Seattle, Washington? Be sure to drop it in the chat so we know exactly who is joining us this morning. And for today's topic, we're going to be talking about building a scalable and transferable business growth strategies for today's WBE. And I'm very excited to work with these women today. And we're going to be moderated by none other than Meredith Moore, who is the founder and CEO of Artisan Financial Strategies. Artisan Financial Strategies is a firm dedicated to helping clients navigate life's financial complexities with clarity and confidence. With more than 20 years of experience, she is known for her insightful, straightforward approach that empowers individuals to align financial decisions with their most meaningful goals. Her own journey, overcoming personal adversity, including a battle with brain cancer, shaped her perspective on resilience, reinnovation, and the importance of intentional planning. At Artisan Financial Strategies, Meredith leads with a focus on inclusivity and innovation, guiding business owners, executives, and high-achieving individuals through critical decisions such as equity compensation, succession planning, and philanthropic giving with a special passion for supporting women, breadwinners, people of color, and those in transition. Thank you so much, Meredith, for your time today. And also, I want to thank you, Angela and Elizabeth, for taking the time out of your busy schedules to join us today. And without further ado, Meredith, I am handing the mic over to you. Thank you so much.
Awesome. Thank you, Sherelle. Appreciate you guys. Thank you, Roz. Thank you, GWBC. Happy to be here. And I have an amazing, actually group of friends. And today's session isn't like 101 session on money. It's a very candid, advanced conversation among women experts on what really happens when you're preparing your business for transition or growth. And really, we want to think of the decision and how we think about this whole ecosystem around valuation, meaning how much is your business worth? How do we value that? Tax and a wealth strategy, all wrapped up into one conversation and moderated by fellow women business owners who can help you kind of connect the dots. And in the reality that we all sit in is that we are not isolated vendors, if you will. We're inextricably wound into each other in planning because we each need each other's services for working with clients. And that's why we're like, we're going to make this just a panel among friends and just conversation. So Angela Dotson, I'll let you go into a little bit more about who you are, but what I'll say is Angela is a badass CPA specializing in lower mid-market companies with structuring the financials and tax strategies that drive clean deals, especially if you're selling. Angela, anything else wanted to add on that? And you are with Aprio, but I'll let you kind of jump in a little bit.
Yeah, no, thanks, Meredith. Thanks for having me. It's great to be here. Financial literacy is a passion point of mine. My parents were entrepreneurs, so, it's personal for me. And so that's why I do what I do. So trying to make a difference and help business owners retain wealth and stay out of trouble. So I'll keep my intro brief, but I'm a tax partner here at the firm and happy to be here to share with you guys this morning.
Awesome. Thank you. And Elizabeth Karp, I just found out some people don't know what valuation is in business. And so we're going to dig in that today. But Elizabeth is a valuation appraiser who shows owners what their business is really worth and why. Elizabeth, anything else you want to add on that? There's a lot to add.
No, I'm grateful to be here. My background is I'm a former family law attorney. I realized about 15 years ago that I love the numbers more than the custody fights, and my background was in accounting. And so now I get to help, small business owners to figure out how their businesses work, what can they sell. So love helping other women. I learned when I was in law school that, it's a difficult world for women out there. It is still male dominated in a lot of areas. And that the way that we succeed is not by tearing each other down, it's by helping each other. And that we all, when one succeeds, we all succeed. So I'm really grateful to be here and part of this group.
Great. Thank you. And I'm a financial advisor. As mentioned, I'm also a certified exit planning advisor. So know quite a bit around exit. And the way to think about what I do is when we see clients, they tend to have a CPA, they'll have an attorney, they may have a valuation appraiser like Elizabeth, and they have somebody in insurance and investments, but nobody's quarterbacking that big picture and balls are getting dropped. And so I quarterback the team. So aligning business value with your personal wealth so that you can plan if you want to keep growing or preparing if you want to exit, but on your terms. So what I thought I would do is start with just a general question that each of us can kind of answer. We're all going to have a different perspective. And so let's start with this. What is the biggest mistake, Elizabeth, that you see before the sale?
Having unrealistic expectations of the value. It's not uncommon that people don't know what their business is worth because you're just working. You're getting an income, you're supporting your family. But people haven't typically done anything to try and figure out what their business is worth. And are they at a place where they're maximizing the value of the sale? And maybe now not a good time to sell because your sales aren't up or your industry is down or the economy isn't in a good position. Just not knowing anything going in. And a lot of people, rightfully so, they put so much work into this with people who cash out their retirements to start a business. They work 70, 80 hours a week and it's got to be worth something. And it might be, but it also might not be. And you need to know that and do your research ahead of time. And you don't have to get a formal business valuation. You can talk to other people in the industry. You can look at publications. You can talk to your competitors and go to events and marketing and just start talking and kind of knowing something before you go into a sale and get a shock that this business you work in every day isn't worth what you think it is.
This whole topic right here and these things that we're discussing, these are where women business owners like literally lose 7 figures before they even realize they're at risk. Angela, what are you seeing?
Yeah. So, I'm going to piggyback off of last week's speaker. If people listened in, business owners don't invest in their numbers. They don't invest in their financials. They don't understand what the financials say. I can't tell you how many business owners have come in with financials that they share with a potential buyer. And, it's easy for a savvy person to know if the numbers are trash. But business owners have to get more engaged and understand how to read their financials, having competent help with the financials. But if the numbers are garbage in, then you're going to get garbage out. And to Elizabeth's point, that is going to drop your sales price if you're trying to sell. And so the numbers and investing in a good financial system are so important. And financials are cumulative. And so you can't just pick a date in the sand and say, okay, next year I'm going to get my financials together, because it's cumulative from when your business started. And so once people start doing diligence, that's where your value starts to drop when your numbers don't look good. So just investing in a good financial system and spending the time to get a little educated on what your financials say about your company.
Maybe are they running personal expenses through their business?
Oh my gosh. So yeah, big rule number 1, separate your business and personal, because that can come back to bite you. Some people think that because they are the business owner, everything they do is business related. To a degree, that might be true, but everything that you're doing is not for business. And so that stuff gets carved out and cut up. When buyers come in, the IRS doesn't like it. So if they come in and see that you commingled, one thing that could start as a personal audit could turn into a business audit, which is more money and more time for you. So you definitely want to make sure that your business has a separate set of books and your personal life is completely separate.
And from a valuation side, just tagging on to that, if you are running a ton of personal expenses through your business, maybe you're doing it so that your bottom line is lower and you pay less tax. But when you go to sell your business, you want to show how incredibly profitable you are. So if you are running, just the crazy things that we see, people pay for their children's weddings. One doctor had a yacht company that was $1 million a year that he ran through business. And if you were running these expenses through your business and your bottom line is lower, you're going to get a lower value. People are afraid. Even when they come into our office, people don't want to admit that they are running these personal expenses through their business. And I don't have anywhere to report it to. My job is to help you maximize your value. And I would imagine Angela, the same thing, unless you're maybe in an audit situation where you have to be on the IRS. But our goal is to help you maximize profit. So if you're paying for your kids' gas, you're paying for your kids' cell phone, you're paying your car payment and it's going on the P&L, not through a balance sheet account. Like, those are things that need to be known and need to be cleaned up, because it's only going to help you. It's going to add money back to your bottom line, which is then going to get you more value for your company. And people just don't know that.
Yeah. Well, and I like to say there's the tax number and then there's the real number. It's called recasting EBITDA. And so that's taking out all the stuff, the country club membership. Think about if you actually had somebody even 10, 20 years from now that was going to buy your business, would they retain that expense? Are they going to keep paying for your kids' camp through your business? And so know that there's the real number and the tax number. To Elizabeth's point, I'm sure Angela would echo that sentiment.
Yeah, absolutely. And from my tax and the business books perspective, you have to keep in mind your bottom line. A lot of people drive their expenses down just to prevent owing tax.
Right. It's the tax number.
Right. The tax number, but that doesn't help you when you go and try to get debt. And so they want to see some profit as well. So if you're trying to go get money to bring into the business to help it grow, you can't bring on debt if you've driven your taxable income down to almost nothing years on end. So there's multiple things, to Meredith's earlier point, that you need to keep in mind, and you can't do it in a vacuum, and you have to communicate with your advisors so that everybody can work together and row together in the same direction.
So I'm going to say something that was really aha moment for me a while back. So many owners I know stay focused. Hell, we're talking about it. They stay focused on the profit and loss, but they forget that growing the value is a means to reach what I call your wealth gap. Your wealth gap is literally your goal. Like, let's say you sold this business tomorrow. How much money do you need? Have you computed that with your financial person? Like, if you had somebody that just walked in, you're not intending to sell, but they walk in, how do you know how much you need? And so I would argue everybody here needs to know their wealth gap, what they need minus what they have today. And think of that as your bogey. So as you're trying to build value on your company, you will grow your P&L in the process of doing that. But by knowing your wealth gap, you have a number to move towards. But knowing that number for everybody here, that's critical, because you'll know whether the exit you want is even possible.
And you need to know it early on. I don't know if you experience that, but we have a lot of people who come in and they say, like, I need this number to be right. I can't make up a number for you. The number is what it is based on whether it's multiple or sales or whatever it is that ultimately values your business. But so often people come in and say, like, I need this to sell for $2 million. I need this to sell for this amount. Plan for that years in advance, not the day that you're coming in to find out the value.
Yeah. So tax perspective on the sale value, you need to be thinking at least 5 years out, because like the restructure and, like, to Elizabeth's point, you need to get to the number. We can't make it be something, but with proper planning, you could get to a number. And so planning is important if you don't remember anything else.
Well, and one thing I think all of us echo is, and our biggest pain point for any professional that plays in this space, is people wait to the last minute. They get an LOI, letter of intent, like somebody's wanting to buy, and then they want to do all this planning. And I don't want to say it's too late, but crisis planning does not yield optimal outcomes. Back to, you will leave millions of dollars on the table. I know one of the first thing we do, to Angela's point, when we're retained, is I got to figure out what your wealth gap is. And it might be a really big number, but there's ways to get there. But by knowing that, you have a bogey so that you can go to an Angela, go to an Elizabeth, and know that this is where we're trying to get. What are the levers that we need to pull in the business to be able to increase the value of your company?
Yeah. And the longer you wait, I think the more expensive it gets also. Small businesses, we often see like the wife or maybe someone's mother is doing the books and they're not trained in it. Like, and that's okay. Like there's things I can't be a teacher, and a teacher shouldn't be doing your books. And if your wife is a teacher and she's doing your books, she's probably not doing it the right way. And if you let that go on for years and years, then you get to a point where you're ready to sell and your books have been bad for years. And so it's going to cost money. And Angela's office or my office is going to have to come in and recreate your books. And that is thousands and thousands of dollars. It could be $10,000, $15,000, $20,000. I had it came a couple of months ago where it was an event venue and it was all the CB involved and blah, blah, everything. But we had to recreate their books back to 2019. It was about $40,000 because they had multiple accounts. I mean, luckily they could afford it, but that's insane. $40,000 so that they could then sell their business just to get to the point where it was available to be sold.
And I see it all the time where business owners don't tell us that they're thinking about selling, and then they show up with an LOI. And sometimes they've shared financial. But what you need to do is share with your advisors first so we can like run your EBITDA and see, okay, what is it? What is the buyer expecting to see? Like, what does your industry say it should be? What's your gross margin? You know, are you efficient at producing your service or your goods? So you need to know before you start sharing with other people and they start looking in the closet at your skeletons, because we can clean a lot up to Elizabeth's point. But if buyers start to see the cracks in the system, then your value starts driving down.
Yeah, that's exactly right. And so what I want to dig into next is, what does exit readiness really mean? Now, there is a big difference between selling your business and actually being ready to exit. And by the way, that doesn't mean you have to exit, but by constantly going into an engagement around growing value, you could decide each year, again, the market's good, I'm going to sell, or I'm going to exit, or I'm not, I'm going to keep growing. But I would love to hear, Angela, from you first. What is the difference between selling your business and actually being ready to exit?
So being ready to exit for me means you've planned and you've prepared for it. If you're not in a fire sale situation. So you professionalized your financials and you have some solid numbers. You're running KPIs and have a dashboard for key metrics related to your business. The founder or the owner has put in place processes and systems that aren't 100% dependent on them running the show. So you need to be able to have other people who are cross-trained to do what the founder can do. You want to have your processes documented. So anything that's scalable and repeatable, like you want to have that process documented to show that your business is ready to scale and that you're not just heads down working in the business, but you work on the business to position it so that you already know the questions that the buyer is going to ask and you've already answered those questions and you like the answers and you're ready, versus somebody knocks on the door and says, oh, I think I'm interested in your business. You have no idea of the value. You don't know what position you're in compared to your competitors, and that's not a good place to be. So being aware of what that buyer is going to look for.
I'd like to give an example. I actually just bought a new home. There's a couple of you that know me in here. And so we did all the diligence, had the inspection come in. So it turns out after all of that, there's 4 failing trusses. And I say that to say that had we known that, I would not have purchased this house for the price point that I did. And so that's a great example on due diligence in a business. If you have a failing trust in your business, you got to figure that stuff out. So if somebody comes and knocking, it looks good.
And kind of tying into a little bit of what Angela said, something that stuck out for me is you need to be ready. Like, can your business exist without you? We often see people who they are the business. And if you are the business, then there's nothing to sell. And without you, there is no business. But most businesses can be transitioned. You just have to be thinking ahead and planning and be ready to sell, but plan ahead for that. And what we see is there's personal goodwill and then there's entity value. And you want to start shifting from your personal goodwill to entity value. And for most business owners, that is scary because people are coming for you. You are the business and you want to start transitioning your relationship. And if you are starting to introduce like your key customers, the people where your revenue is coming from, to employees, so that when you're gone, still feel confident calling those employees. There are a lot of business owners who are very scared that, well, if I let Angela know all of these people where my revenue is coming from, what if Angela said, I don't need Elizabeth anymore, I'll just go start my own business? And I really think there's two key parts to that. And you can kind of stop or prevent both of those, because it really comes down to either do you have bad, untrustworthy employees, or do you have a bad environment that is causing people to be that way? If you have bad, untrustworthy employees and you don't want to let them in on the relationships that are driving your revenue, then those people shouldn't work for you. However, maybe it's not that they're bad employees. Maybe there is a bad environment. You have a bad manager. Maybe you're a bad. I know that's a difficult question to ask yourself, but why are people not loyal to you? Why are you afraid that they're going to steal your business? If you created an environment, I think like firm where I'm in, and I'm sure it's the same with Angela, there are 5 partners, there's 8 of us who are like project managers. Everyone brings in business. And at any point in time, I would imagine any of us could say, I'm going to go out on my own, but we choose not to, because like for my side, that I like the company I work for. I like the people I work for. I like the opportunity. I believe that together we are building something bigger, and I want to be part of that. I don't want to go out on my own. So the partners in our firm aren't afraid that we're going to take the business and run, because we have an environment where that's not fostered. We want to be part of this group, and you need to be able to transition your personal will to the entity so that people want to come for the company, not for you. But you need to know that when that is coming, and it's going to take time, it's going to take years. And so you might be ready to sell today, but it's going to take 2, 3, 5 years to transition that relationship so that people trust the company, not just you.
Yeah. And thank you on that. You know, I talk about owner dependency all the time. And listen, there are a lot of lifestyle businesses that are certified women business, and there's nothing wrong with that. You can have super high margins and create a lot of economic value outside the business. This particular talk is if you are truly trying to scale, reduce that owner dependency to grow equity value that can be significant. And contract businesses, as a lot of people have relationships with, the way those are valued are very different. So I think we're talking about truly, I think you use the term, Elizabeth, entity value, not just the personal value. And so that's going to be key. The biggest thing in terms of readiness that I think of is if you don't know what your walkaway number needs to be, you're not ready. Back to the wealth gap. And you all echoed it. Like they're just trying to get what they can get. They never knew from the beginning what they needed to get, because once you leave, once you've done that sale, that transaction, it's done. And unless you're going to go back to work, most people don't want to. We got to know what that number is.
Yeah. And then some people have to stay on in a transaction. To Elizabeth's point, they haven't made that transition of relationships. And so the buyer will require you to stay on 3 to 5 years to make sure that you can retain those clients and customers. And that's not the ideal exit for a lot of people, but that's the situation they find themselves in with lack of proper planning.
And what we see too on the valuation side is there's even a factor of if the company continues to perform at a certain level, because they want you in and they want to be able to see that it can be transitioned and that your price could go down if you can't keep up or transition those relationships, and contracts start falling off because you're not there or you no longer own the company. So it can also impact how much you ultimately receive.
And that's great, guys. So 3 to 5 years out, what should you be doing now? You know, too many owners wait until they're burnt out to start planning. I think we talked about this, but Angela, what should people be doing now instead of waiting?
Yeah. So 3 to 5 years out, you want to look at, to your point, Meredith, what do you need? Like, what is the number? Like, what is your number? Right. And then to Elizabeth's point, what is your company valued at right now today? And so you take those pieces of information to figure out, what can I do to maximize my company's value. Having multiple lines or streams of income, not being too heavily concentrated in one customer. I had 2 clients who are really struggling. Like their business was set to have the best year ever in 2025, but they were super dependent on Target. So 2 product companies, they were going to have the best year ever. 2025 comes along, Target is where it is, and the boycott and just all the things that are going on with Target. Now they're having the worst years ever. One client had multiple streams of revenue and is able to stay afloat. The other client is thinking about selling their dream home that they just bought during COVID because they can't keep up. They don't have other multiple lines or other major customers. And so the difference between multiple streams of revenue that can kind of help you buffer a storm if something doesn't happen to you directly, but what if something happens indirectly in the market? So you want to, protect yourself in multiple ways. I think too many business owners don't have access to debt. And so I always encourage business owners to get a line of credit or get one personally if your business doesn't have enough credit. So you want to have access to some capital in case something does happen, because when you need it, it's too late. Like you need to have it in place when your numbers are looking good, when your company is strong. So when the tide turns, it's too late to go and get that now. And so those are a couple of the key things that I think people need to start looking at now, because they can take that extra money to invest in the company, but then understanding what is going to give me that biggest return. And so just spending a little time studying your clients and your customers to understand where you need to put that focus.
Yeah, that's great. And so for me, where I sit, when we begin an engagement, I first start around de-risking the business. If the value of your business increases by 200 grand, but you got hit by the bus, and with what Angela was talking about, you're backing all the debt, you have the relationship with the bankers, there's no liquidity in the business, it's game over. And so I'm always looking at, on the personal side, is there enough life insurance in place, both for the business with key person as well as personal, disability, long-term care? Do we know what the wealth gap is? Have we gotten that valuation done in a preliminary way that Elizabeth talked about, so we know where we're starting? And I think, Angela, you said it. I need a number now. Like, what's the business worth today? It could be worth $2, but if we know the wealth gap is 15 million for you to be able to walk away, we got to figure out, like what she was saying, we want that value advisor that can help us do the things to increase the value of the company. It takes time, but getting help early on to layer in the de-risking process. And by the way, having an estate plan is also part of that de-risking, and making sure the operations agreement really lines up. So many times business owners are so busy, they just haven't done this. And having an accountability partner where you have a team and somebody quarterbacking it, they can help you get some of that stuff done. So last minute fixes don't work in this.
No. And some people have, run their business so long, the operating agreement doesn't even reflect the current state of the business or the current ownership of the business. And so you definitely want to make sure your legal documents are up to date and in order, and that you're not kind of stumbling into things. I ran into this a few weeks ago. A company was selling years before they worked with us. They worked with another provider, and they had a really hard time proving that they had made certain tax elections along the way, and the buyer wanted proof or the number was going down. And to Elizabeth's point, they spent thousands of dollars for us to go dig and investigate and, find documents that just somehow were not in the corporation's permanent records. And so just being mindful of, are my documents current, and do they reflect the current ownership, and do they reflect my intent? Because some people have documents and they get into a sales situation and they realize my organization documents say all these other people are going to get money as well, but that's not what they really intended. And they didn't, think that all the way through and put some numbers to it. So it's super important to know what your documents say.
I know we're always trying to get a review of that every 2 years. It may seem excessive, but it doesn't, because life just changes, businesses change. So let's move on to the next one. Why do deals die? Let me tell you how deals really die. And no, it is not what you think. Angela, you've touched on some of it.
Some of it is bad numbers. I'm going to say it, a broken record. Sometimes the numbers that people show up with that they pull out of their QuickBooks or that they've given to their CPA are bad numbers. And so your financial statements say one thing, they start doing diligence on your numbers, find out it's something else. Too many personal expenses running through the organization, too many relatives maybe involved in the organization and not the most competent talent pool in the business, hidden tax surprises that are uncovered when due diligence comes in and they find out that there are liabilities from a tax standpoint or some litigation matters separate from taxes that get uncovered, some debts that buyers don't want to take on. But when you're not buttoned up and other people find your mess, it kills your deal.
Great.
And also, I was saying, going back to what I talked to earlier, unrealistic expectations. It's not uncommon for people to think that like you have $1 million in sales, so your business is worth $1 million. So we hear people say that all the time, like I have a $2 million business. No, you don't. You have a business that has $2 million in sales. And when you get to the table and you're seeking, like bids, offers, you're looking for buyers and you want a particular number and it comes in much lower, that shock causes them to refuse offers that they don't want to take. And when you refuse the offer and that's the value, you're not getting anything. And then there might not be anyone who's going to make another offer.
Wow. That's scary, but where I sit, it's misaligned proceeds. Back to, we figure out the wealth gap and we're targeting that, but surprise, you have to pay capital gains when you sell your business. And there are a lot of professional service fees. When you're selling a business, I mean, you're going to have literally, depending on the size, but you're going to have 6 figures easy in professional service fees from people like all of us here in the panel and the lawyers. I can tell you that right now, the business attorneys. And so they forget about that. Yay, my wealth gap was 10 million and I had to pay out over $500,000 in fees to get it done. And that's not unheard of.
Yeah. And then the taxes. Some people don't understand how the structure of the deal can drive whether it's capital gains or ordinary income. So it's super important before you sign deals to let professionals look over your document, because as the seller, you want to have capital gains, but the buyer, they want to buy assets that they can depreciate and capture that benefit right away. So there's a little bit of tension right between what the seller wants and what the buyer wants. And so many times you see unintended consequences where a number is thrown out, a person gets excited, they sign it, and then on the back end, when we're doing the taxes, it's like, oh, well, this is not all capital gain. And remember all that accelerated depreciation you took? Now you're bringing it back into ordinary income. And it's possible that you could pay half of your proceeds in tax after all is said and done. And so then that's eroding away at that number that you thought you were feeling in your wealth gap.
And the small business context, a lot of people are shocked by like the payout that you may say you're selling the business for $500,000. You might not get $500,000. You might get $250,000, and then the buyer takes the $250,000 note to be paid off over 7 years. So you may not get the pot of gold that you're hoping, depending on particularly like small businesses, or if you're in kind of a niche industry or something where the buyer doesn't have a ton of capital to just give you $1 million. They can come up for whatever, and then you're going to be bought out over time. So you're not getting the money that, that gap that you needed for your retirement. It's coming over a certain number of years.
I've seen that as well. And I've had some buyer beware, seller beware issues with clients where the deal, it just wasn't a good deal. And they took on seller notes with a relatively unknown entity buyer, and they were so excited to sell and just wanted to be out. And then over time, they didn't get those additional payments, and there's no recourse because the buyer didn't have any money. And so now they just didn't get what they thought they were getting. So you really have to be careful who you're doing these deals with and kind of do some diligence on the organizations or companies that, might be potential candidates. But
That's always like having a filter where for however many years, you're just constantly focused on growing the value. You don't have to sell.
Right.
Like somebody could come in, but you want to be in a position of power to where if the right deal came along, you hit your wealth gap, you have everything structured, you didn't depreciate the whole dang nut, that you're going to get what you need. The reality is most people don't think about this 10 plus years in advance. They do it less than 2. And it drives the attorneys, the CPAs, the valuation people, and the financial advisor quarterback nuts because we're in crisis mode and our fees are going to go up.
And what I feel on is the decision is made for someone due to unforeseen circumstances. Your partner dies and their family can't get out, or there's a divorce and somebody got to be bought out. I had a horrible situation earlier this year where the business owner made a comment on Facebook, and one of her major customers didn't like what she said and refused to do business with her. And it was a third of her revenue. And I don't know, luckily is not the right word, but luckily she could sell off that line of business. She did get some kind of value, but that didn't really help her. She lost a third of her business. Yes, she's getting a one-time payment, but her revenue's down a third simply because of a comment she made on Facebook. Her business, part of her business had to be sold. She wasn't planning for that. The decision was made for her, essentially.
Well, that
5 years plan. It might happen tomorrow.
Well, that and back to diligence. I had a trust and estate attorney. He was telling me he had a case where they were in diligence and literally going through of all the things, all the IT systems. And one of the employees had kiddie porn all over the computer. So guess whose deal did not happen? So because now there's criminal investigations, the business was not de-risked. There were problems, and it's like all sorts of bad stuff can happen, basically.
yeah. And then on the documents, if you are a multiple owner business, what do your succession documents say? Like if your business partner died, are you in business now with their spouse? And so most people don't want that. And if you're in the middle of diligence and they see that, your business is structured in such a way where they might now unintentionally be in business with that person's spouse or kid, that's going to be a deal breaker. So you want to professionalize your documents and think through some of these scenarios before they happen.
Yes.
It's not a deal breaker. It could lower the value. In valuation, there is a concept called discount for lack of control. And it goes to exactly what Angela just said. If your 30% of the business is worth $250,000, based on the number, it's not worth $250,000. It's worth less than that because you only have a third control. There's two-thirds other people who have control. So it's actually worth less because you don't have that control that Angela was just talking about. And you need to know that piece and how much that impacts you.
So I had a case where there were 2 business partners. One of them, he got cancer. He did not have any disability. They had no disability buyout to tie to the operating agreement. So he had to stop working. The other owner just stopped paying profits. So there was no K1. And eventually my client died. Now they had a life insurance policy that was owned by the business that was meant to fund this. It's called an entity purchase buy sell. The problem was the other owner took off with that money, and the now widow had to sue the other owner, but there was nothing there. And so I'm back to the de-risking. Nobody cares about your $200,000 growth if the business is not de-risked at the front end. The estate planning docs aren't solidly in place. Anyway, I know we're telling all the scary stories today.
But unfortunately, they happen. I mean, my business is mostly related to a litigation context, but nearly everyone who comes in the door doesn't want to be here. I didn't plan on it. It happened to them, unfortunately, that they weren't expecting that someone was going to die or that a partner was going to steal from them. I mean, that's just horrible. I think we had a business with a father and 2 sons, and the father and one of the sons fired the other son. Like, you never think that's going to happen. Like, he fired his own son, fired his own brother, and now they're in litigation over the business. Like, no one expects that it's going to happen. until it happens to them. And hopefully it doesn't happen to you, but it could happen at any moment, unfortunately. You got to be ready for it, or at least have an idea of what you might do if it happens to you.
And then I'll just add briefly, be careful of aggressive tax positions that you take because those trail. So if you take aggressive tax position, then engaging some of the things that the IRS calls the dirty dozen, like in diligence, they're going to specifically ask you, did you engage in any of this? And if you did, to Meredith's point, now you didn't de-risk. And so that might be a carve out and a liability that they want you to continue to be responsible for a set number of years because they don't want to walk in and take on some surprise liability when the IRS finally knocks on your door, which if you ever had any IRS issues, it's years later. It's not in the same year or two that it happened. And so you just have to be careful with the positions you're taking now and thinking about how that's going to affect you in the future.
I'm going to jump into a couple of the questions before we got other stuff we want to cover too, but I want to jump in on a couple of things. So Lenny asked, actually, was it Lenny? Sorry, I just saw something. Oh, here it is, Sharon. Minimum number of people should shoot for to feel comfortable retiring within the next 3 to 5 years. I don't know if you meant a minimum dollar amount you need to get from the business. I don't know what the question was there, but a quick way to figure your wealth gap out for everybody to break out their iPhone calculators. I want you to figure out what you take home personally. You know, whether that's 100,000, whether that's $1 million, and literally divide that number by 0.04. So quick math. So $1 million divided by 0.04 is 25 million. So the answer is you need 25 million if you are personally bringing home $1 million every single year. And so what I want you to do now is subtract what your net worth currently is. And that is your wealth gap. And so if you stop working tomorrow, that's the amount that we need to have the right advisors to help you grow your business so that you can sell it for that net of taxes. And then Samantha, I'll come back to you on that. I'm going to jump over to another question real quick. Valuation multiples and buyer types. You know, buyers don't pay for top dollar for potential. They pay for proof. Elizabeth, what do you think about that?
Absolutely. So a buyer is essentially making an investment. When someone's buying your company, they're making an investment and they want to see that what they're investing in is profitable. And they need to see that the product or the service that you're selling is going to continue to make them money. And there may be potential to grow the company, sure, but you need to have something that they can grow. And just having this potential, and maybe there are situations where someone might buy potential, but there's going to be a heavy discount. So you want to have proven sales, proven value, proven results to be able to convince the buyer that what you're selling them is going to continue to make them money, because that's ultimately the goal. They're buying your company to make money.
That's great. Angela?
I would agree. I wouldn't necessarily add anything to what Elizabeth is saying on that particular one.
Oh, that's fun. So one thing that I'm always looking at is we have quizzes, and at the end, anybody that wants, I'm happy to get to you. We have a business exit attractiveness, an exit readiness quiz, so you can kind of see where you are and like where your gaps are. Look at those with a lot of checklists to see where we are. So then I can send people on over to Elizabeth and Angela to help them grow that value even more. Post-sale regret.
Can I add real quick, Meredith?
Please, yeah.
There's a lot, like when you're getting to this like readiness idea, there's a lot of businesses where like potential, kind of going back to that, people get complacent and you start making enough money to support your lifestyle and what you want. And you have a number of employees, and that's as much as you can manage. You don't want to take on more because then you have more work, you have more to manage. And with part of that readiness, I think too, is deciding, is there more value that you're leaving on the table? Are you willing to go at where you are right now? Or if you put in more work and you increase your marketing, you increase your team, you increase your sales, do you want to put in the 2 or 3 years of work to get to that? Or are you ready right now with where you are? And maybe you're fine being complacent where you are now, But I think that's part of the readiness piece too. Are you complacent or are you truly ready?
Yeah. And I would add on to that on, are you ready? And like, what is it going to take for that growth? You need to have a budget and a forecast. And you need to back down into, okay, if I'm trying to grow my business to X, and if I'm trying to do it over 5 years, then what growth rate do I have to have for 5 years? What does that revenue need to be? And do you have complacent team members who aren't doing the business development that they should be doing? And so you definitely have to, put some numbers on the spreadsheet, pen to paper, and chart this out and track it. Because if we're at the end of September, what was the budget? Do you need to reforecast? You have a quarter left. Can you make it? Can you push? Like, what do you need to do? But you don't want it to just fall out where it falls out. Like, you want to drive the process and have the opportunity to tweak expenses. Like, clients look at their expenses, take a scalpel to it. If your revenue is not where it needs to be, then you probably need to bring some expenses off that P&L and make some hard decisions. But you don't want the numbers to just fall out where they fall. Like, you want to drive them and really look at them, because financial statements are historical, but budgets and forecasts are forward looking. So you want to make sure that you're doing both.
And it's okay if you decide you don't want to put in the work to grow. You just have to recognize that someone else may put that work in for you and you may lose out on that value.
And the flip side to all this too is I'm a fan of making sure that we're at least creating some economic value outside the business, to where not everything is tied up in there. The reality is we know that's going to always be your biggest asset most often, but by also taking some cream off the milk, if you will, and creating some other assets, whether it's even a qualified plan or a 401k inside your company that you're personally contributing to, but having some other things where everything on your balance sheet is not just tied to that business. And so by having somebody like a quarterback that's overseeing all of this is going to be critical from day one to create that relationship early on. I can't tell you how many times I see the last minute, the last hour, the wealth manager comes in that they haven't met, has no relationship, doesn't know anything about that business other than the fact that they're getting ready to exit. And it's usually, I'm going to say something, Roz is going to just cover her eyes, but it's the old white guy from the big bank. And you know what? Sometimes you want to have somebody that's with you along the way that can get you to the end and to that finish line and help your network and get to the right people.
A lot of what I think, I do a good bit of work in the divorce context. And so we get into people's like personal finances. And the sad reality is that most people spend everything they earn. And there are people who have these huge businesses and they have a house and they don't have retirement. They don't have investment. They've made a ton of money from their business and there's nothing to show for it. And I mean, it's just the sad reality of the world that we live in. People make a ton of money and people spend a ton of money. And where it's that you don't have a financial advisor like coming in early and telling you what plans to, how much money to take and where to put it and what distributions to take. You maybe, the business may not be enough when you sell it to fill in the gap, but you had the opportunity for 20 years to build wealth. You just have spent it all on cars and vacation and going out. I mean, the amount of money people spend on going out to eat is absolutely insane.
Astronomical. And I'll say there's a fallacy that business owners have that every year is going to be a better year. Every year, things are going to keep going. I'm going to make more in my business next year than I did last year. Sometimes that's true, but that's not going to be true for every single year. It's just not going to be. And a good rule in business, the same way it is with your stock portfolio, you need to diversify. And I'll never forget, right before the real estate crash, we had a client that had all of their money tied up into their real estate business, all of it. We begged them to take some off the table. It was mostly residential real estate, and they were making so much money. And they were like, no, let's, put a little more, just one more year. And then the market crashed and they literally lost everything. And I mean, they were, 65 and they couldn't start over and they just had to start walking away. and letting things just fall. And it was the saddest thing I ever saw. And it's the story that always sticks with me. Do not put all your eggs in your own basket. So you definitely need to take some money off.
Thank you. Let's do a lightning round and like 20 seconds each. And then we'll go to Q&A. If that works for you, Sherelle. Okay. So your business might be growing, but is it actually sellable? Each panelist, one piece of advice every owner should know now.
Plan ahead.
Understand what your financials say about you.
Whole picture, your life, your number, your freedom. Okay. So let's dig into some more Q&A really quick. So let's start here at the top. What is a budget investment expectation to get de-risked? Thank you for asking. So my fee typically starts at $5,000 for the year. It just depends on the nature of the business and the scope. Reach out to me at the end. You'll get everybody's email. Sharon, again, I think I answered that. Is there a minimum number or dollar amount to shoot for to feel comfortable retiring in the next 3 to 5? Again, take what you're bringing home now. What lands in your bank account, divide it by 0.04, and that's how much you need. That's principal if you just lived off of that the rest of your life. Lonnie, thank you. Dollar, Lenny. What's been your experience on the best way to have employees participate in the upside of the sale? I think that's a good Angela question. And Elizabeth.
Yeah, so I've seen where a lot of people have given their employees, their high-performing employees, not all employees. You want to be careful when you do this and be very thoughtful, but a lot of people give them phantom stock. And so they only get a benefit if the company sells. So they're not necessarily participating in the day-to-day or the year-to-year profits, but if there is an opportunity for a sale, then they're tied to some phantom stock in the operating agreements of the company. So that's a nice way to reward people if there's a huge exit. Bonus strategies,
it's like a stay bonus, basically.
Stay bonus or production bonus. So if the founder is bringing in all the business, and you can incentivize with some commissions if your top employees can meet some high targets. You want to just, pay them for anything, but like put some targets out there that they can reach for and feel the benefit of reaching for it. Because a lot of times they just think the owners are walking away with everything. So if you can give them a little taste, that'll help them be more engaged.
And really just the way that you treat people, even as little things as, time off. Like my husband's company does this, like they don't have PTO, but obviously it's controlled, it's regulated, but he can take off anytime he wants. The company that I work for, I could, after this talk, I could leave the office, they do whatever I want, because it's an element of trust that if I need to go and do whatever I want, they trust that I'm going to do my work. I'm going to get my work done. I'm not going to miss deadlines. So to me, there's a lot of just like the environment and the way that you treat people and the courtesy that you can give, to them. Bonuses, time off. We just randomly have lunch will be brought in sometimes during a meeting, holiday, giving a gift card to people at a holiday. A lot, there's numerous companies who like close for a week during the summer, and then a lot of law firms close like the week between Christmas and New Year's to give their employees that off. You can do things that are not significantly impactful to your bottom line, but that foster a sense of loyalty and community. I mean, our company, one time we went to the Braves game together. We go bowling together. We go randomly to lunches together, just fostering a community where it feels like they're part of the team. And they're all growing. And you can do other things such as letting people in on some of the financial piece. And you don't have to tell them we're doing $5 million in sales, here's our budget. But when you involve them in however much you're comfortable with and you trust, like involving them in the finance, letting them know, we're struggling. Or like I remember one thing, our managing partner during COVID said, no one is going to get fired. Like right after COVID happened and everyone was scared. She was like, we have access to credit. We have loans. No one is going to get fired. She made that promise. That created so much goodwill and loyalty among all of us hearing that from her. But that wasn't a dollar value that she put on it, but it created this goodwill and loyalty that we all heard that and realized like these people care about us. It's not just about the bottom line.
Yeah.
culture is super important in sharing the vision. Well, Elizabeth, to your point, and giving them the opportunity to participate in how you're going to drive the value and like what are their ideas. A lot of times people have ideas and want to be heard, they just don't have a platform for it. So just giving them the opportunity to share their thoughts from their seat in the organization is helpful as well.
And you'd be surprised by how much the sort of core workers, the people know and what they're doing. There's often a gap between like the owners and the people who are doing the work and the management piece. You know, like you learn a lot from talking to your workers. We did one year, I think a partner president did like a survey and it was anonymous. And so she went around and talked to every single person in the firm to find out like, what are your complaints about this? What are you concerned about this? You know, like truly like, and it was truly anonymous. She didn't tell anybody what the particular said or who it was. But we learned so much from that people aren't willing to say, I don't like working with this person or this person's mean. Or one of the feedback for a particular person was that they were always in like an urgency. And, you know, like they don't do stuff and then it's urgent and everybody has to drop everything. And that person would never have told that to anyone else because they were afraid of the repercussions of the person they were complaining about learning it. So, you know, create culture and find out a lot from the people who are actually doing the work and not just talking to your managers who are going to tell you what you want to hear.
Yep. Thank you, ladies. I just want to let everybody know everybody's email is up here. All of us are willing to do calls. All of us love supporting women in business. And I'm also certified. So I've been at conference the last couple of years and I'm giving away, if you email me, I'll send you that exit readiness quiz just so you kind of know where your gaps are. If that's something that would be a benefit. Thank you, Angela. Thank you, Elizabeth.
You, Meredith.
Absolutely. Thank you.
Thank you.
Roz, thank you so much.
Roz, did you have anything that you wanted to add?
Okay. All I can say, I took notes, but I will tell you this information. Hopefully those that have had the pleasure of being able to hear all this information are going to have taken copious notes too. We will provide you a copy of this as well, because a lot of information was shared, valuable information. And to me, I think there needs to be a part 2 for this because it is so important for businesses, especially today, and making sure that more of our women businesses clearly understand valuations, understand succession planning, and looking ways that they are going to be able to maximize their dream, you know, because everyone wants to look at an exit plan at some point in time. And so Elizabeth, Meredith, Angela, I mean, you all were phenomenal, great information. I'm hoping that emails are going to start coming in because they're interested in connecting with you also, because that's going to be key as well. And I will share with you, believe it or not, here at GWBC, we do get the phone calls, at least I do, because of the confidentiality of mergers and acquisitions or selling, you know, their business and asking me questions about things of one, how to maintain their certification. That's one of the things that they're trying to do. But I will say to you that we need to see how we can get more of this information out to our women businesses and quite frankly, just the small businesses as a whole for them to understand. Hopefully the audience was okay with all the stories. Sometimes those are the reality checks that you need to hear to say, am I in that space? Or am I near that space? Or I'm far away from it and I'm going to put these particular steps in place so that I don't get there. So again, phenomenal, great information between this accelerated series today and the one last week. Our women businesses that attended armed. And so thank you so much, Meredith. As always, thank you for putting this panel together, this phenomenal panel together. And we look forward to you all, hopefully, sharing this information again or more information with us. Thank you. well, and Saeed, and that's our production team. Really appreciate everything that you all do to make this series available to our WBEs as well. And of course, to the Accelerated Committee. So very excited to have this group of women businesses involved in bringing about all of the different subjects that we have shared throughout the year.
And again, we would love to see you follow us on social media using the hashtag. Share some nuggets that you really liked from Meredith and Angela and Elizabeth today using the hashtag GWBC Accelerate on Facebook, LinkedIn, and Instagram. And if you're looking for more information on the Accelerate series or just the GWBC programs and events, be sure to contact myself, Saeed, or Roz at info@gwbc.org. And with that, like Roz always says, have a great rest of your week.
Bye.
Thank you, everybody.
Thank you.